Welcome to today's Explainer. Today, we are putting Manulife Financial Corporation through an absolute gauntlet of evaluation test. I'm stepping into the role of your expert investment analyst, and we're going to tear into the source data, looking at Manulife's Q1 2026 earnings reports, their dividend histories, and investor presentations. We're going to test this stock against the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, just to see exactly what the numbers are really telling us. We've got a lot of ground to cover. We're going to kick things off with a quick company snapshot, then put it through the ringer using the Buffett, Lynch, and Graham lenses. After that, we'll run some quantitative models and wrap it all up with a final synthesis and recommendation. All right, let's jump right into Section 1, the company snapshot. We need to set the stage. If you think Manulife, trading under the ticker MFC, is just your run-of-the-mill Canadian life insurer, think again. Founded way back in 1887, this company is a global wealth and asset management powerhouse. They employ over 32,000 people. We're talking about a massive institution here with a giant footprint heavily spanning Canada, the United States, and Asia. What's genuinely wild about their Q1 2026 data is the sheer geographic spread of their core earnings. A massive 38% of those core earnings are coming straight out of Asia, while global wealth and asset management is pulling in 25%. This kind of diversity is absolutely crucial. It's like a built-in shock absorber that provides serious resiliency against regional economic downturns. Okay, let's lock in our baseline metrics from that Q1 report. They posted a core return on equity of 16.5%, a book value per share of $26.30, and a Q1 core EPS of $1.06, which annualizes out to about $4.24. They also declared a quarterly dividend of $0.485. Now, because we need a stock price to actually run our valuation models today, we're assuming a conservative current market price of around $32, which is based on their historical yield patterns. Moving right along to Section 2, let's look at this through the Warren Buffett lens. You probably already know how the Oracle of Omaha operates, right? He's hunting for very specific traits. He wants a durable economic moat, consistent earnings, high returns on equity, honest management, and debt levels that aren't going to sink the ship when times get tough. He also focuses heavily on owner earnings and demands a clear margin of safety. So how does Manulife stack up? Honestly, it kind of crushes it. Do they have a moat? Definitely. They hold a leading category position in Canada and top-tier scale in multiple Asian markets. Earnings consistency? Core EPS is up 11% year over year. High ROE? It's sitting at a really robust 16.5%. And their debt is highly manageable. That financial leverage ratio dropped down to just 22.5% in Q1. But Buffett is all about that margin of safety based on owner earnings, which is the true cash a business generates for its owners. A disciplined value investor isn't paying full price. You want to buy $1 for 80 cents. So we typically look for at least a 20% discount to our calculated fair value before jumping in. Given Manulife's robust earnings growth and market dominance, it strongly fits the profile of a Buffett-style stock, assuming we can get that entry price comfortably below intrinsic value. All right, shifting gears to Section 3, the Peter Lynch lens. Peter Lynch is a totally different beast. He likes to categorize a company first to understand how it behaves. Then he leans heavily on the PEG ratio, that's the price-to-earnings ratio divided by the growth rate, just to make sure he isn't overpaying for growth. Oh, and he absolutely demands a fortress balance sheet. Under Lynch's system, Manulife is the textbook definition of a stalwart. It's a massive, established company that pays a rock-solid dividend. If we use our assumed $32 price and that $4.24 EPS, we get a PE of roughly 7.5. With their core EPS growing at about 9 to 11%, our calculated PEG ratio comes in at approximately 0.8. In Lynch's book, anything below 1.0 is highly attractive. And the balance sheet? It's heavily overcapitalized. Their LIKIT ratio, which is essentially the regulatory safety net measuring capital for rainy day, is sitting pretty at 136%. Just to drive that balance sheet point home, look at their credit ratings. A tier across the board from both S&P and Fitch. Plus, they have an incredibly strong liquidity position, generating a massive $32 billion in 12-month rolling cash provided by operating activities. Through the Lynch lens, Manulife is a resounding buy. Now for Section 4, we're bringing in the father of value investing himself, Benjamin Graham. Graham doesn't mess around. His defensive investor checklist is notoriously strict. He demands immense financial stability, adequate size, and a continuous history of dividends. Well, looking at Manulife's dividend history, they've paid out consistently since 1999, so that's an easy pass. He also insists on very moderate price-to-earnings and price-to-book multiples, and Manulife easily satisfies both at current valuations.
Let's do the math on his legendary intrinsic value formula. It's actually pretty straightforward. You multiply a base of 22.5 by the company's earnings per share and its book value per share, and then take the square root of that whole thing. So, our inputs from Q1 2026 are that annualized core EPS of roughly $4.24 and a book value per share of $26.30.
When you plug those numbers in, it spits out a staggering intrinsic value of $50.09 per share. $50. Compared to our assumed market price of $32, that is a massive margin of safety. Graham would absolutely touch this stock. It's trading so far below his strict intrinsic value calculation that it makes for a super compelling deep value play. Okay, moving out of the history books and into Section 5, Modern Quantitative Models, specifically the DCF. Building a base case discounted cash flow model for a massive financial institution means we need some solid assumptions. Since it's a financial firm, we proxy free cash flows using their stated core earnings. We're applying an industry-standard 9% weighted average cost of capital, or WACC, and a very modest 2% terminal growth rate to figure out our terminal value. This is where it gets super interesting. Check out how resilient this valuation is when we stress test it. Our base case, sitting at a 9% WACC and 2% terminal growth, gives us a fair value of $41.50. But look down at that bottom row. Even if we heavily penalize the stock with a harsh 10% discount rate and a sluggish 1% growth rate, the fair value is still $33.20. That is still sitting comfortably above our assumed $32 current price. And we're not stopping at the DCF. If we run a dividend discount model, Manulife looks highly favorable. They've recently hiked their dividend to a very robust $1.94 annualized. With a consistent history of dividend growth, the DDM gives us a very high floor for valuation. Then, looking at comparable multiples, Manulife continues to trade at PE and EV/EBITDA multiples that are well below historical industry averages. The underlying value here is just rock solid. Finally, we've arrived at Section 6, the synthesis, and our final recommendation. When you put it all together, every single quantitative and qualitative lens points in the exact same direction. Graham's strict formula hands us a $50 target. Our DCF base case lands at $41.50, and both Lynch and Buffett's frameworks trigger a strong buy based on that sub-1 PEG ratio, the durable moat, and the consistent ROE. At our assumed $32 price, the stock is trading at a significant discount across the board. Now, to be totally fair, it's not all sunshine. We do have to address the elephant in the room. In Q1, Manulife faced $4.4 billion in wealth and asset management outflows. That definitely highlights some short-term, market-sensitive volatility. But honestly, the core earnings strength, the robust capital, and the compelling undervaluation heavily outweigh that risk. Ultimately, Manulife passes this valuation gauntlet with flying colors, triggering a strong buy recommendation. So, having seen all this data, from Buffett's moat to Graham's deep value formula, which guru's lens are you going to trust for your own portfolio?